Let's talk a little bit about money. We all know that money can do three different things. It can go up in value, it can go down in value, and it could stay the same. If we could eliminate one of those, obviously we would eliminate the down. The next thing to look at is the Dow, or the S&P, how we measure the stock market. Now, do we think that the Dow is more likely to go up 30% or down 30% first? I think that 85% of America would agree that it will probably go down before it goes up. So here's the question that I always ask. In year number one, if the Dow goes down 30%, and in year number two, it goes up 30%, where will you be? Sort of a trick question, because most clients say, well, I'm back to even. But let me show you why you're wrong. Let's assume we invest $100,000 in the market. And in year number one, it goes down 30%. Okay, so we lost $30,000. We now have $70,000 in our account. Year number two comes along, and the market does this miraculous recovery, which it almost never does, but we go up 30%. You think that you're back even. Actually, no, because we only had $70,000 in our account. It goes up by 30%, so $21,000 is our recovery. We now have $91,000 sitting in our account. So the question is, we're not back even. Even if the market rebounded 40%, that would be $28,000. We're still down. So the question is, you're playing with something that really can affect your retirement, and you need to understand how the numbers work to protect your retirement. Now, to further talk about the stock market, there are three different types of markets that happen, okay? There is what's called a V market. The V market is where the Dow is at one point, it drops, and it immediately comes back. That's a V market. They're usually short in nature. The next market is actually what happened to the Nikkei market in Japan. What happened was they were at a certain level. Their market crashed, and it has never come back. It has stayed the same. That's called an L market. The United States actually has what's called U markets. A U market looks like this. We've had a lot of U markets where the market goes down, it stays down for a while, and it comes back. In the 70s we had one in the 80s where it went down, came back. But the grandfather of all grandfathers was this one. In 1927, the market was at a high. Along came 29, and it crashed. That market actually didn't come back to the level that it was at until 1958. So you had 31 years of the market being depressed. If you retired during that period of time when it was down, I don't know how anybody would have had enough money to live. So understanding the market is a very important thing, and here at ABMG, we try to show this type of information to you so that you'll maybe be a little bit more cautious with your retirement funds.